How will you be affected by inflation? Welcome to another presentation, Inflation, the Fed, and You, a labyrinth. So what's going on here? That's the big question everybody wants to know. During the COVID crisis, there's been a massive expansion of the Federal Reserve balance sheet. There's been stimulus, and no one really knows where the money is coming from. Hopefully I can answer some of your questions. So Federal Reserve's balance sheet. We can see here starting in 2008 going to 2020 and today, we see the expansion of the Federal Reserve's balance sheet. And it's expanded in multiples of GDP. So right now we're sitting at $7 trillion is the Fed's balance sheet. And that consists of quantitative easing, Main Street lending, and a whole alphabet soup of programs that they'll tell you are doing all sorts of good things, and hopefully they are. So we see that assets have increased almost double from the start of the COVID crisis to the end of the COVID crisis. So over 7 trillion in assets. Try and imagine that number. That's insane. So here's my second chart I want to show you, the M2 money stock, or M2 money supply. So this chart goes from 1980, starting bottom left, all the way top right to today, 2020. So here we can see that it's been fairly constant. Every recession, the money supply has gone up in the same amount, except for a little blip here in 2008. Not really a big deal. Averaging about 2% a year in increase. Then we get to here, and I drew an arrow just so you would be able to see it. We have today's increase, and then here's a blown up picture of that same thing. So the money supply, M2, has gone from 15,400 to 18,400. So that's an increase of around 20%. That's unprecedented. Since the start of the gold standard, or the end of the gold standard, excuse me, in the United States, this has never been done before. 20% increase in the money supply. So you could consider that an inflation in terms of the amount of money that is out there. So that's what most people would think of inflation. That's not what economists think of inflation. And they target 2% inflation. But what is this 2% that they're targeting? And where does that come from? Let's answer that question here. So it comes from something called the Consumer Price Index, or CPI, which is a basket of goods put together in a group like gasoline, groceries, movies, vacations, whatever, potato chips, all put into a basket. And they consider this what the average family in a metropolitan area consumes in a year. So we can see that they target, like I was saying, around a 2% inflation. So this is not a flat thing. This is a rate of change. So it's constantly going up. So our Federal Reserve is targeting a constantly increasing CPI. But we can see here they don't always get it. And what happened here, this is called deflation. Deflation happens here. That oftentimes will happen in recessions. We don't see that pop up on the money supply because the money supply will be constant. It's just the CPI that will change. So here we can see that we know we're in a recession now. The CPI, the percent change, is going down. It's still positive, but it may go down and go into deflation. We don't know yet. But let's compare and contrast this graph to the money supply graph. Look what happened. This one has gone up 20%, and this one has gone down. Now what does that mean? There's an increase in money supply and a decrease in the Consumer Price Index. That means goods like gasoline, like I was talking about before, food, those prices are going down. Why might they be going down, and where is the money going? It's going into savings. This is important. So as you can see here, the savings rate has been fairly constant for the past 70 years. It's held around 10% per year of income. So you might notice what happened here. The savings rate actually went from less than 10% to over 30% and hit an all-time high of 32%. So that means for every dollar the average American earned, they were saving 32 cents, or every $100, $32, any way you want to think about it. So that's a massive change. So that's money that would be going from being spent on goods like the gasoline, the consumer price index goods, into savings and investment, which would consist of the NASDAQ, the S&P 500, and we can see that demonstrated here as people go from spending money on CPI goods into investment. The price of investment goes way up. And what happens when the price of investment goes way up? All assets will have a much lower yield. But we'll get back to that. So here's how that happens. Interest rates on the left, loanable funds, which is the quantity of savings, yada, 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 whatever. So here's the savings curve. So this is the curve that households in America will be willing to save. And here's the savings old, and let's say that the savings increased a lot, because as we can see, the savings went from 10% to over 30%. So that's a massive shift. So at the old savings, and here's the corporate investment, the old savings, the interest rate is here, let's say. At the new savings, the interest rate is going to be down here. So that's a massive decrease in the interest rate. So the interest rate might be the rate of return you're going to make on your stock, bond, real estate, renewable energy, whatever it is. And we can see that here, the amount of funds loanable is going to increase. So that follows the savings rate increases, the loanable funds increases. So that means all assets will have a much lower yield. So what does that mean exactly? That means the market rate of return for stocks, bonds, and all other assets, real estate included, will be lower. So if you're used to making 10% on a stock, you may only make 5% on that stock now. And that will all change. And we can see that in this graph of the NASDAQ. Prices are being pushed to all-time highs here on the right, from near-term lows to all-time highs. That means that the yield you're getting from that investment, the percentage increase in the price or dividends received or stock buybacks, whatever, is going to be much lower for the price you paid. So like I said, if you're used to getting 5% on a stock, you may only get 2.5. If you're used to getting 10, you may get 5. I'm not saying it's going to be half, but it's going to be dramatically less for an extended period of time. And we can see that here. So S&P 500 is around 5%. That's going to be much lower for this reason. Here's a graph of U.S. 10-year Treasury interest rate. So this is the rate of return on a government bond, a 10-year bond. We can see it hit an all-time high in 1980 at 15% and has been in a bull market for the past years, culminating to today where the interest rate on a 10-year bond is less than 1%. Now, that might not seem like a big deal, but that is for one important reason, the inflation rate here. So like I said, the Federal Reserve is targeting a 2% inflation rate in terms of buying power in the CPI per year. So you have to subtract out the return that you're getting from your bond. So let's say you're making even 1% on your bond somehow. If you're getting 1%, you subtract that 2% for inflation, and you're left with negative 1% in real buying power,